Good morning, everyone. Thank you for joining us for Training Tuesday. Today we have, hold on, I'm trying to make this go away. There we go. Today we have Taryn Armitage, who is a lender with Citizens Bank. And to carry on with the theme that we've been doing the last couple of weeks, we're going to be talking about refining your home mortgage. And she's going to talk to us about utilizing either lines of credit or HELOCs, which is a home equity line of credit. I think they may be the same thing. I don't know. She's going to go over it. But Taryn recently helped a girlfriend of mine who is a homeowner and owns her home outright and was able to pull some equity from her home to update her kitchen. And so I was like, man, this is something that we all need to know about, especially those of us who are looking at utilizing these funds for either home renos, using the cash out to pay down some debt, utilizing it to buy investment properties, even though the market is crazy. But with that, I will let Taryn take over. And I am eating breakfast, so I apologize, but go ahead. Let me switch it to speaker view. There you go, babe.
Good morning, everybody. My name is Taryn Armitage. I am with Citizens Bank in the commercial lending side, but I do also do consumer loans. And today I'm going to talk about the different types of lines of credit that are available. So first of all, what is a line of credit? A line of credit is a flexible loan from a bank with a set credit limit that can be used for a variety of purposes. You can repay immediately or pay over a period of time. Think about these lines of credit similar to like a credit card, but there is always a maturity date. So lines of credit typically have lower interest rates as compared to credit cards, but they are similar to a credit card in how you can use them, being that you can use them for a variety of purchasing needs. Different types of consumer lines of credit. There's revolving lines of credit, there's straight lines of credit, and then home equity lines of credit. The revolving is more like the credit card, whereas the straight line of credit, you start with a zero balance and you build it up as you need to use the funds. And then once it's been used to the maximum limit, then you start paying it off, but then you don't reuse it. A home equity line is specifically when you use your primary residence, sometimes a secondary residence, as collateral for that line of credit. And then I'll talk a little bit about business lines of credit. Again, there's straight lines of credit and revolving lines of credit. So what type of line is best for you? It just really depends on your needs and what type of collateral you have. I'll stick more to the home equity side. And if you have questions about other lines, I'm happy to answer those in this session or through email, text, phone, whatever works for you. Most oftentimes I see people use the consumer line of credit or the home equity to consolidate their personal debt, do home improvements. Sometimes they use that line, those funds on the line as a down payment on a second home or an investment property. I did have a lady pull out money on her home so she could buy her daughter a house where she was attending college. And then I have people that have used a home equity line to help pay for their children or their grandchildren's college tuition. And also it's sometimes, nice to have on the back burner as a cushion for any emergencies. And then the business lines of credit, business cash flow, your cash cycle, quick access to short-term funding, inventory or equipment purchases are primarily what lines are used for. And then the way the payments typically work on lines, and it does depend on the banks. I have actually called other banks to see how their home equity programs work, and not all banks are the same. I do think Citizens probably has the best home equity line of credit program. Typically we offer a 5 or a 15-year term, so you don't have to renew this annually. Whereas traditional business lines of credit are good for 1 to 2 years. And then at the end of that 12 or 24-month period, it's time to renew it and so on. But with the home equity lines of credit at Citizens Bank, once you establish it, it is good for 15 years. typically you're only going to pay the outstanding, your payment amount is interest only. Doesn't mean you can't pay down the principal balance. But then at the end of the maturity, you are required to have that paid down to zero. That's kind of all I had just as far as like my notes. I kind of wanted to open it up for questions for anybody that might be looking into one. Like Summer said, I helped a girlfriend of hers and now she's my girlfriend. We're great friends now. But yeah, she had some debt she wanted to pay down. She had some kitchen remodel that she wanted to do. And I encouraged her to kind of go for a higher amount on her line for unexpected costs, because we all know we have someone who's doing the work and they say, oh, it should cost this much, but in this day and age, prices increase every day.
Yeah, my husband's actually doing her renovation and we're glad to have a little bit more wiggle room because the cost of cabinets increased tremendously.
You don't want to end up cheaping out on some things because your funds are limited, especially with, renovations to the home. You want them done correctly. But so we gave her a higher amount than what she had originally asked me for, but she's not paying any additional money except for what she has outstanding on the line. So if I'm not going to give you her number, but say her line was $60,000. If she only ever uses $20,000, that's all she's going to pay interest on is that $20,000, not the full $60,000.
Oh, that's a good piece of info. So
yes.
I have a couple of questions that I had pre-written out for everybody. So if anyone wants to jump in, feel free to do so, but why don't you take us through the process and the approval? And I think that would open up some more questions because I know you have to have like your last 2 years taxes to show income. That's how you guys determine the amount. I don't know if your credit score comes into play or.
Yes, so we do like to see last 2 years of tax returns. Let's say you were applying this time of year, it's the middle of 2023. You should have your 22 taxes filed. If not, at least your W-2s from 22. We would need, and then also I like to see current pay stubs. If you have a traditional job that you do receive a pay stub from, we like to look at the last month's pay stubs to see if there was, maybe you have a pay increase that, you have more income than you did in 22. We do look at credit. So we do pull your credit. And as far as the home equity, we do have a program where we don't have to necessarily get a full-blown appraisal on the property. We have a third-party company that we kind of just plug in the address and it spits out a value based on recent comps in that area. So it is, I'd say it's fairly accurate. I usually ask questions about the home. Is it, how many bedrooms, how many bathrooms? Because sometimes that third-party company will ask us detailed information about the house. And for example, the lady that I helped with Summer, she had actually done some add-ons to her house in previous years that wouldn't have shown on Zillow or anything like that. So with that additional information, it was very helpful to get the most accurate value for her home. And on home equity lines of credit, just for easy math, let's say your house is worth $100,000 and you owe $60,000. We can extend a line of credit up to 75% of your home value less your outstanding mortgage. So 75% of 100,000 is 75,000 minus your outstanding mortgage of 60,000. You can have a line for 15,000.
And that's something y'all implemented after the housing crash, right?
Correct.
I remember Baca telling me that when we did mine.
Yes, and there are some banks that might go up higher on that loan to value. And in some cases, we do make that exception that we can go up to 80%. I've seen sometimes we go up to 85, but traditionally it's best kept at 75%. And for you too, as the.
Oh yeah, I know it's a safety measure on behalf of the bank because so many people got in trouble with it and from 08 to yeah. So does that, utilizing that third party, does that waive that $500 appraisal fee or? Okay,
yes,
cool.
so it ends up just being like a $13 fee.
Oh, nice.
Yeah.
And then what types of interest rates are we looking at these days?
So our bank, we tend to base our stuff off of Wall Street Journal Prime. Let me pull up what our rates are as of today. So as of today, Wall Street Journal Prime is 8.25%. And it's usually prime plus X amount. So prime plus 1, prime plus 2. And we try to, let me get that real quick. It'll take me just a second. But, you know, right now with the rising rate environment, you are looking at a rate of, let's just say prime plus 1. So 9.25%, which is pretty high. But if you're looking at consolidating debt or doing home improvements, that's a lot cheaper than getting a Home Depot credit card or using your existing credit cards that are 15, 20, 25%.
Yeah, that's what I was going to say. Like and 9% in recent years sounds like a high interest rate for most, but just because we were in that 2 to 3% range for so long.
Yes.
But my father, whenever Mike and I purchased this house, it's actually funny because we bought it directly from the homeowner, and it was our first time. And so we didn't know how to negotiate or anything like that. And my dad read through it and he was like, this is 3.25. He's like, that's free money. He's like, just sign it.
Yeah.
Probably could have saved about $10,000 had we known a little bit better. But when he bought his first home in the mid 80s, they were paying 17% on home loans.
Yes.
So,
yep.
So even at 8.5 or 9% is, and then comparatively to a credit card, like you said, and this offers more flexibility as far as like, you know, if you needed a cash front from your credit card, there's a higher fee for that. There's more risk. Yeah. So, and then what types of collateral? Obviously, if you own your home, you can utilize that, but you mentioned the business. So you would do a business valuation or?
So oftentimes on the consumer side, we stick to property. So your primary residence or any investment properties you have. On the business side, sometimes we take your office space as collateral, like the actual property itself. We do like real estate. It's safe collateral. Yes. But sometimes we take your accounts receivable. We file what's called a UCC with the state, so that we kind of have a first lien on all your accounts receivable. That's a little higher risk in banking, but it can be done, and we do them all the time.
If it's a client that you have a strong relationship with, or you've seen repeat business, that kind of stuff.
Yes. Yeah. And so FF&E, furniture, fixtures, and equipment, we can take equipment as collateral, or like say you're a salon, you know, your sinks, your chairs, that type of stuff, that's considered furniture and equipment. We can take that as collateral.
Yeah, I saw Melissa just jump on, and I know in construction, it's that type of equipment is usually a safer bet, just because obviously those retain value.
Yes.
So another question that I get asked a lot is, you kind of already touched on this, but does my house need to be paid off? So obviously not. You said that, but usually, how many years would you say it would take to have enough equity to even look into this? Like years 2 to 5 or 5+?
So it does depend when you first get your loan, did you already put 25% down, or were you someone who only put maybe 5 or 10% down? So you do want to work yourself down to somewhere under that 75% loan to value. Now, obviously, currently values are very inflated. So it is easier when we pull the value on the home versus what your mortgage was. Even if you got it 2-3 years ago, you probably already have quite a bit of equity that you may not even realize you have.
So I did a cash out refi in 21. We were doing updates to our house. We were putting in refrigerated air, and we decided that if we were going to do that, we needed to go ahead and update the windows, because otherwise we were just air conditioning the neighborhood because the house was old. Precision Mortgage walked me through that and did most of our paperwork. So and also I trust Jen a lot. So it was mostly just sign here, sign here. I didn't ask a lot of questions. But we were fortunate that at that time, we actually lowered our interest rate from 3.25 to 2.7. But I will say that the process, because we had our paperwork in order and everything, the process was super easy. We refied through a different company, paid everything directly out, and now I'm still married because we have refrigerated air. Because I was like, I don't know how we made it through 10 summers like this. I can't believe I haven't murdered all of y'all. And then the woman that I referred to you did say the process was pretty easy. She had to, well, people in general, keep in mind that if you're self-employed, if you're lowering your income to save on taxes, it's harder to borrow. You've heard Marcy say that a lot, like, talk with your tax advisor. They should be asking you, are you planning on borrowing in the next year or two? How do we need to show income? Because as business owners, we tend to like write off. And we pay ourselves the, bare minimum. What can I get away with without red flagging? So could you talk a little bit more about the fact that your income is coincides with how much you're allowed to access?
Yes, absolutely. So some of the criteria is not only acceptable credit score, but we look at DTI, debt to income. So how much debt do you have in comparison to your income? So if you are self-employed and you're trying to minimize your tax liability, you're essentially minimizing your income that could disqualify you from a loan, like one of these lines. And sometimes you'll need a guarantor. So either if you're single and maybe your partner is living with you, but you own the house yourself, your partner could co-sign with you. They do not have to be on the deed. We don't have to add them to the deed.
We went over that, and somebody had misinformed her of that, because I was like, don't put them on the deed, that's your house.
No.
So that's a really good piece of information.
So this person maintains ownership of the home. However, the loan is both her and her partner's responsibility. So, I mean, if the bank had to repossess the home, yes, it really affects her, but he's on the hook for the loan without being on the deed. And I think that helps a lot, maintain independence, and you don't always have to, it's funny, collateral can be just a variety of things, like 2 people are on the loan, but 1 person owns the collateral.
What is, I mean, ideally, we all want a 750, 800 credit score, but what would be, what's in that safe range if someone came in with like a 625 or a 650? So
our minimum threshold is 625. Okay. And sometimes when we look at credit, it could be a variety of reasons why it's lower. Maybe there's a bankruptcy, maybe there's late payments. But maybe there's not a bankruptcy. Maybe there are just a few late payments that were in the beginning of 2020. We all know what happened in 2020. If there's reasonable explanations and you at least meet that 625 score, we can approve it knowing, okay, well, this person only had 3 late payments in March, April, and May of 2020. They were laid off. That's why. Yeah, you can see they got a job and they've not had any late payments since. Sometimes there's very reasonable explanations for lower credit scores. Sometimes there's not. I often get oh, well, my ex-husband. Well, we understand divorce happens all the time, but you're still responsible for your credit. So it's something, if you're open with your lender right away saying, I know my credit score is low and here's why, we're more likely to work with you on it than if you're just, if it's consistent and derogatory late payments. We don't want to lend to someone who doesn't pay their loans back.
Have you been seeing a lot of this activity recently?
With late payments?
No. I meant like people coming in to utilize these for home improvements or.
Yes, I think with the inflated values on homes, especially speaking in Las Cruces, we do have people that are looking at different resources and ways to have quick access to cash. So we are seeing an increase in them. I think, though, I always caution people to be careful with how much they want the line for, just because I think at some point, I don't have my crystal ball and I'm not in real estate, so it's not best for me to say, but you know, these inflated values will eventually trickle down. I don't expect that we'll have a 2007-8 crisis again, but you don't ever want to be upside down on your home.
Mhm.
And I would always recommend, you know, using the line for things like home improvements, you know, purchasing a second home. I do get some people, oh, did I
You're
go
still-
away?
No,
Okay.
you're good.
I do get some people that, well, I want to go on vacation.
I was just about to
Well,
say,
maybe
so
you
don't
should
use
see-
this
you
for
can
Disney
use it
World.
for that. There are some banks that do limit what you can and can't use the lines for. Our bank does not. For example, if you called me, you have the line open and active, you call me, I need $10,000 from my line to my checking account. I make the transfer. I can't tell you what you can and cannot spend that money on the consumer side. On the business side, there's sometimes we put conditions and exceptions in place to help navigate the customer's cash flow, help push it the way they want it to go. So we're, you know, a little more in control with the customer so that their end goal is met. But as far as the consumer side, the home equity side, if you want to use it for a vacation and you have it available, go ahead.
Okay, and then so when you're talking about a loan versus a line of credit, so a loan, would you get the full lump sum up front? And then the
Mhm.
line of credit, you request it as needed?
Correct. Yes. Yep.
Okay.
So, yep. What, just like a straight line, we often call it, or just a regular loan, is the money is just given to you up front. Sometimes if you're paying off debt, the lender might say, well, we will issue those checks to those companies. So we'll write those checks to pay off X, Y, and Z. And that kind of gives the bank some assurance that those debts were indeed paid off to help with the debt to income ratio.
Yes, I've seen that happen too. And then I've always thought that, and this is my father-in-law talking, he's telling me, he's like, well, I've always had a line of credit because he also had rental properties and such. And he's like, I like that I could go out and take out, you know, if I needed the 5,000 to do an update, I do that, I pay that off, and then I go back. So he wasn't just pulling it all at one time,
Right. Mhm.
utilizing it very responsibly.
Yes.
I think that that's something that people need to realize, is that it's easy to think that, oh, this is just free money. But you can also get in a lot of trouble that way if you're not being structured and paying attention to how you're handling it.
Right. Generally, when I go through the loan process, I let you know, based on this amount of credit we're extending to you, your maximum payment, should you fully advance it, is going to be this plus interest. So it's something that I hope sticks in the back of their mind that, oh gosh, if I did use all of this all at once, I'm going to have a monthly payment of $900 and my mortgage is already $1,100.
Yes. Okay.
Whereas, okay, well, if I only use 5,000 now and I work on paying that down, I can use it again in the future.
Yeah.
And your payment's not as high.
Ladies, do you have any specific questions? I've heard of people taking out some portion of their equity in order to purchase investment properties, or I don't recommend buying a boat with it, but I know that that's kind of hard right now though, because you're, like you said, with the inflated housing prices, I mean, it's hard to take out a portion of your cash out option because you're not really finding anything less than 200. I mean, even
Right.
200
Yeah.
is difficult. Mostly it's less than 250.
And one thing to think about, I did a cash out refi as well, instead of a line of credit, because my rate was better. But now we're in a higher rate environment. I did it about the same time that you did. So
Oh,
with
that's-
some of that cash, we bought our second investment property. What else did we do? Yeah, the second investment property, and did improvements to both houses, both rental properties, but
Which
it
is smart,
was-
because that's also a
yeah.
tax
Yeah.
rate.
So it did end up, a home equity is not the only solution. I would talk to your lender and ask them about a home equity versus a cash out refi. Sometimes even the cash out refi still might have a lower rate. It just depends what your needs are or what your future plans are. You know, some people want to accumulate more investment properties, and having the line of credit open for 15 years is a great way to do that. Whereas the cash out refi, that's just a one-time lump sum payment to you.
Yeah, and you have to trust
When you
yourself
do
to
the
not
refi.
mess with it until the right property comes along.
Right.
So I know that after doing the cash out refi to do our personal improvements, if we were ever to look at this, I felt like the line of credit was a smarter move, because also we're locked in at the 2.7% with the former refi. But I know that, I mean, we currently have quite a bit of equity in our house as well, since purchasing it in 2011, even with the refi.
Mhm.
So we've talked about looking into a line of credit for additional purchases or other investments. So, but I don't think that I personally would do another cash out refi, just because interest rates have changed so much.
Right. Yeah. I think you should look at what your current mortgage rate is in comparison to what it would be if you did a cash out refi versus keeping your lower current mortgage rate and a higher home equity rate.
Yeah. Well, ladies, if no one else has any other questions, and I will tell you, everyone's always nervous because sometimes we finish in 20 or 30 minutes. I'm like, these do not have to be a certain time frame. It's
Yeah.
basically to get the information across quick and easy. And so if they have any other follow-up questions, they can reach out to you. Oh, Tiffany, go ahead.
So hi Taryn, this is Tiffany. In my parents' situation, they have a manufactured home. They don't owe anything on it. They have a lot of property, but I know they've been wanting to make some improvements on their home. Does it matter, or are manufactured homes, do they carry a less I know that their value is not as much as a regular home. So how does that work with the manufactured home?
So we do on occasion at Citizens Bank make home equity loans with a manufactured home. However, sometimes we might do it a little different, where maybe we're giving the value of the loan on the land rather than the home itself. And the reason for that tends to be that a lot of manufactured homes usually aren't set in the ground. So sometimes our collateral could just disappear overnight. So whereas if we take the land collateral as collateral, we can still do a line of credit very similar. It would just not be called a home equity. But given if they own it free and clear, there's a lot of options they have with that. And I'd be happy to talk to you more about it through email, phone call, text, whatever works for you. But essentially just because it's a manufactured home doesn't disqualify it from having a line of credit.
Okay, thank you.
Since we do have Debbie on here, is there any tidbits, Taryn, that you can think of where a nonprofit could or would utilize this or benefit from it?
Yeah, absolutely. So I think business cash flow, the business cash cycle, sometimes just because they're a nonprofit, they still are a business. They might need quick access to short-term funding, or like in Debbie's case, maybe she needs a new ultrasound machine really quick. Or other equipment that she may have. And if she has a line of credit established, she would just have quick access to that and a little flexibility in the payments to get
And
that paid.
honestly, Taryn is so easy to work with, you guys. If you're intimidated by this process, like seriously, call her, reach out to her. She makes it so painless. And she's super patient because I am completely challenged in this arena. And so it really does become almost effortless. She just says, okay, here's step 1, 2, 3, and you do them, and it's great.
Thank you, Debbie.
Hey, Summer. Hey, Taryn.
Hey,
Since I'm stepping on, I got here about 20 minutes late. Will you email me the recording so I can rewatch it?
Yes, of course. I'm going to send it out to everybody. Did you hear? Oh, am I muted? Did you hear me?
Yes,
Cheers.
no, that's perfect. Thank you so much.
No problem, babe. I will piggyback off of what Debbie said. I have not personally worked with Taryn. Although once I get with my CPA, I may reach out to her, but right now he's slow. But my girlfriend that I sent to her said she'd been to a couple of credit unions and another bank. And like I said, they had kind of misinformed her as far as like that her fiance needed to be on the deed, and it was left to her from her family. So I didn't want her to do that. So Taryn was very upfront with her on the information, straightened out some misinformation that she had heard. And then she said this was wonderful to work with, walked her through the whole process. And I'm happy to hear that you guys are friends.
yeah. No, she's been great to work with, and it is hard. I would say I always recommend not just going to one bank. Now, if you have an established relationship with a bank, obviously go to them, but you know, credit unions do tend to have lower interest rates. But I know the local credit unions are kind of changing their structuring and their business models. And this isn't to talk down on them, but it is the exact opposite of what Citizens does. You know, First Light has now taken all of their employees out of their branches and everything's video and all of that. So I think that does make it harder if you are with a First Light, for example, and you're not able to talk to someone in person. Reach out to other banks. Yes, I work for Citizens. I have for 17 years. I do have all of my primary accounts here, but you know, I help my dad with his business, and he's at First American with Farrah Marquez. She's wonderful. I would highly recommend talking to her and her team about any lines of credits as well. And of course, I would love your business, but First American Bank and us, I mean, we're the two true locally owned and operated. They're not locally owned, they're out of Roswell, but I will say they give the same customer service that Citizens Bank does.
Yeah, the three that work with us are you, Pioneer, and First American.
Yes, Pioneer. I was thinking of Keel. I couldn't think. Yes, Keel at Pioneer. He is also really amazing. I know a lot of the women in the association had worked with him a lot in the past, and I have nothing but great things to say about him and Farrah. So
yeah. Well, cool. Well, ladies, Melissa, I'll get that sent over as soon as it uploads. I appreciate you guys logging on. This will go out later today or tomorrow. Melissa, because you want it, I'll try and get it out as quickly as possible. But Taryn, thank you so much for your time.
You're
back
welcome.
from your vacation. Congratulations on your pregnancy.
Thank you.
Yay. And did you guys all get let me stop recording. Hold on.